The pivot is closer than we think, or surely it has to be. Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Alex, who's been spending some time thinking about the rate pivot, and it might be coming not from what we thought, from lower inflation, but actually forced upon the Federal Reserve by a whole range of other conditions all coming together at once. Should be a great conversation I've been looking forward to. How are you going today, Alex?
I'm going very well. How about yourself?
I'm going very well indeed, and you just covered so much ground in the news today. I think there's a lot for us to discuss. So let's dig straight in. First of all, talk to us about this potential for a short squeeze that you identified. What does that mean, and just how significant could that be? Because that graph certainly painted a picture that it could be a big deal.
Yeah, so what was interesting about that graph from the news is people have been calling this short squeeze in bond markets for 6 months. And I was looking up articles and things back in May 23 this year. Macquarie Bank in Australia was saying there was going to be a big short squeeze. Now, that was when the short squeeze level was sitting at about 1.2 million of bonds.
Yep.
1.2 million in, like, not in value, but in actual bond numbers.
Yep.
And now we're at 2.83 million. So that can has well and truly been kicked down the road a long way. And, you know, there's been hedge funds piling into it, but it sounds like, and it looks like, individual investors are starting to jump into the short squeeze. And we always know that's the end of a market. So it's looking very precarious, but it's doubled since someone else made the call, so you can always keep going. But these levels, that glitch last week that we spoke about, it could be the potential starting of a short squeeze. Well, at these levels, that would actually make sense. So that is going to put pressure on the Fed because, as you know, if yields keep increasing, bonds decrease, and there's a whole heap of pressure in the US market right now that does not give that room to keep going.
Yeah, okay, so that all makes a lot of sense. Now, you also talked about another aspect coming into that where treasuries are actually outperforming the S&P at the moment. And that's a pretty significant situation that's going on, and it's going to result in money certainly moving around. And that's the point that you were kind of making there. So how does this factor in as well? Because this is another angle we need to be considering.
So stock markets are starting to come off, and as they come off, people are looking for yields elsewhere. So it now looks like, so if you don't have the capital gains that you were getting in stocks, you're only looking at yields. And the yields in the S&P, for example, are 3.5% lower than what you'd be getting on the 2 years. So 2% in S&P and 5.5% close enough in two-year bonds. So as an investor who isn't going to get the capital gains somewhere else that you normally get in the share market, they're going, well, hang on. If we go into the bond market, first thing is I'm getting 5% on my money now, which is amazing.
Yep.
Second thing is if rates do drop and the pivot does happen, which everyone's talking about, we have an inverted yield curve where the 10-year bond is sitting at about 4.5%. So everyone's expecting this to drop at some point. And then you actually get capital gains in your bonds at that point too, because as yields drop, you get capital gains there. So everyone is looking at this trade and going, why stay in stocks, which can be risky if a recession comes? Why not get out, go into your AAA rated US government bonds, get out and start earning 5% and potentially huge capital gains?
That makes sense, but there's a few other issues around that play as well, because, and this is where it all gets complicated, right? Because as you put all these parts together, it just keeps getting more and more uncertain about what the eventual outcome is, because you're also talking there about the upcoming flood of new treasury issuance that's about to hit the market. So when you think about that, that's a lot. How is that going to impact when you consider that people might be shifting to actually liking that trade?
Yeah, so $10 billion a day in treasuries, whether that's replacement or new debt. So we know that the US is running at about a $1.5 trillion deficit, but we all know that number's not right. So it's going up a lot faster than that. So you've got those numbers and that amount of debt that's coming in. But what can happen is if the market is flooded with bonds, well, there is a point where people don't want them anymore, or there's not enough money going around to buy them. And what that'll actually do is push the yields further up, and that means bond prices come back off. So that capital gains we were talking about has the potential not to be there unless these rates start coming off. There's just no money for this.
And I have heard that mentioned elsewhere, that people who I was listening to were saying there is actually always a buyer for bonds, but it just depends on the rate. So it's like, you'll always find a buyer, but the rate may be substantially higher than what we have at the moment. That's exactly what you were just saying there,
but
right?
You also have China and Saudi Arabia, who were the biggest buyers before selling. So that is being absorbed in the market at the same time. So that's on top of the $10 billion a day of issuance.
And that's why it becomes tricky, because you can't exactly pick the outcome of that. But you would tend to think the pressure is certainly going to be on, if they're trying to issue more, on those rates to spike higher. That's certainly what I've been worried about. And then just one other aspect, if we don't have enough already on our plate here, you were really talking about something that I hadn't seen too much commentary on yet, but I think will be front and center again, this idea of downgrading the US credit rating again. And we've obviously already seen that, and it wasn't really that big a deal. I mean, we spoke about it in the lead up to it, but we didn't see that much market action around. It was sort of, yeah, okay, it's downgraded, but we're not really changing what we did. But that, if Moodys does that here, is it bigger this time because that's sort of everyone on board? How do you see that situation unfolding?
So Moodys has come out today and said they're going to downgrade. They're looking at downgrading the US US credit rating. Now, Fitch did it back this year. I think it was Fitch, wasn't it, in August this year?
Well, there's a couple of them, and I think when we're talking about them,
there's three. So the three big ones are S&P, Fitch, and Moody's. S&P, well ahead of the curve. They did it back in 2011. Fitch more recently, and Moody's, the last holdout, is now talking about it. Now, the interesting thing is why Moody's is talking about it. So Moody's is talking about it because we have another government spending standoff in the US, different to the ceiling that we had before. So this is the new standoff, which is where the House has to pass budgets. So in order to pass the budgets, they need to get the Republicans and the Democrats to agree on things. The Democrats at the moment are pushing to get Ukraine money out the door. They're also pushing for more and more spending. The Republicans on the other side, after the debt ceiling standoff and the open checkbook that they gave the Democrats, have basically had enough. So they are holding strong this time. They'll be looking for more compromises than they got last time. So we are basically 5 days now away from another government shutdown in the US. Goldman Sachs estimates that for every week there is a shutdown, it drops GDP by 0.2%. So they're not small numbers.
That's extraordinary, like that number. So 0.2% a day.
Sorry. A week, yeah. So Goldman, 0.2% GDP per week. So that's not a good number.
But when you think about the debt ceiling sort of impasse, which there was a big lead up to that, but we're not really even talking about this, and we're only 5 days out. Like, that could go on for more than a week. I've seen these things go on for weeks. Like, that's a big hit.
These are certainly the ones that go on longer. So, we'll see what happens. But what is also interesting is then you've got student debt repayments, which started again this month.
Yep.
And, you guys have touched on in Ainslie before the credit debt and how that is just increasing at an astronomical rate. My point here is rates this time hurt people more, because we have a 30-year fixed rate mortgage rates in the US, which means as mortgages go up, people don't feel it as much. Now, that has slowed the building market in the US, but it hasn't hurt consumers. But we're about to hit a point where government employees won't be paid. That hurts consumers.
Yes.
Student debt is now being paid off. That hurts consumers. And credit card debt is at a record level, and that hurts consumers. So the rates that we're seeing on bonds and out of the Federal Reserve are about to bite the US economy all in one go. You know, in Australia, they hurt our mortgages, and we've slowly been adjusting to it. This will be a very sharp hit.
It's almost the equal and opposite reaction swing that they get, because they got away with it being so relatively
Minimal
subtle,
compared to the world.
because of those long dated mortgages that they have. So that, you know, it is different to here, where most people are on variable rates, and, you know, each impact you feel it a month or two later, whereas there you might not feel it for years. But that's the flip side, right? That when it does catch up, it wallops the market, because some of these things all happen at once that it was sort of papered over before because it was nice and smooth.
Yeah, look, to go from, you know, no payments on your student debt to rates, I'm sure that must be up above 7%, to go, you know, to increase credit card debt, lose all the savings. There's not many places now for the US economy to hide like there was before.
So if we wrap all this up, because there's multiple aspects to this that you've discussed there, and some of them appear to be pulling in opposite directions, which is why it's so confusing and why we keep having to come back to it and discuss it and think it through. If all this is happening and coming to a head all at once, what is a Fed governor to do? What are they going to do here?
Okay, so it's not all in opposite directions, so to speak, because if rates do go up, two things can happen. They can go up and the Fed drops and they all come down, or they can just be stretched, which is sort of what's going on, where the spread might be bigger because Moodys has downgraded them, or because there's too many bonds being sold, which means the Fed will still have to drop rates. So it may get to a point now where the Fed is dropping rates just to maintain bond prices where they are, just to maintain yield.
Such an important point. So you're effectively, they're not even doing, it doesn't change anything. We're still where we are now, but they have to drop rates just to stay where we are now. That's such a important insight.
Yeah, so that's the way to look at this now. So if this does have a sharp effect on the US rates, which it's all lining up, the Federal Reserve will have to drop the US dollar. You know, will drop. You and I have a different view on that slightly, but and these bond prices may not move.
Yeah, no, I do agree on that part of it. We were just sort of debating a little bit about what the actual impact on the US dollar is specifically, and that it's all tricky, right? Like it's very tricky here, because
risk off is US dollar, but US dollar is the risk.
Yes, that's exactly right. And from my angle, I'm sort of going, there's a lot of assumptions that it just reacts in the same way that it always has in the past. And I mean, to be fair, that's the safe play, isn't it? To think the most likely reaction is the rush to US dollars, the flight to safety, the things we've seen in the past when this happens. But where it just gets a little bit complex for me is, do people rush to the ultimate cause or the underlying cause of the instability in the first place? And maybe this time's different, always dangerous words. So happy to watch and see how it actually plays out. But yeah, I can see an argument for both. That's for sure.
Yeah, no, look, I can too. And, you know, these things sometimes go one direction and scream back the other way. So never look for the first direction.
And that's a good point as well. And I've been saying recently, I know what's going to happen next, not necessarily what's going to happen immediately next. So I know what's going to happen after we get that chaos and that pivot, and when the market settles into that new regime of more liquidity and really, you know, where we were back in the quantitative easing days. But I don't know what's going to happen in the immediate future. It's much less clear.
Yeah, and I mean, you know as well as I do that this quantitative tightening thing that we've got going on at the moment, well, the US Federal Reserve's lost close to $1 trillion this year just on decreases in the bond holdings from the US dollar, the US bonds they've got.
Yep.
So, you know, is that really tightening? So what has to happen to ease from here? Like, it's pretty big positions.
I absolutely love these conversations with you, Alex. So thank you for that today, digging into all of those specific details. It's the area that I'm most fascinated about. I might not be able to predict exactly what's going to happen next, but at least if we keep digging around the edges, we get build our confidence that we are ready for what's coming next, at least, or at least have an opinion on it. So thank you for that.
No problem. 5 days till the government shut down. And yeah, we'll see what it does.
We'll by this time next week, we'll no doubt be discussing that in a lot of detail. So yeah, looking forward to that one. Thanks everyone for watching. Remember, reach out with any questions or comments on social platforms. That's us for today. We'll be back tomorrow with Branko and all things to discuss all things markets and metals. Until then, have a great rest of the day, everyone.